and as such, it must eventually pay your money back to you with interest. Investing for income means that you have to consider your investment's yield. If you want income from a stock investment, you must compare the yield from that particular stock with alternatives. Dividend-paying stocks do have the ability to increase in value. They may not have the same growth potential as growth stocks, but at the very least, they have a greater potential for a capital gain than bank CDs or bonds. Your investing style isn't a blue jeans versus three-piece suit debate. It refers to your approach to stock investing. Do you want to be conservative or aggressive? Would you rather be the tortoise or the hare? Your investment personality greatly depends on your purpose and the term over which you're planning to invest. Conservative investing means that you put your money in something proven, tried, and true. You invest your money in safe and secure places, such as banks and government-backed securities. Conservative stock investors want to place their money in companies that have exhibited some of the following qualities. Proven performance. You want companies that have shown increasing sales and earnings year after year. You don't demand anything spectacular, just a strong and steady performance. Market size. Companies should be large cap, short for large capitalization. In other words, they should have a market value exceeding $10 billion. Conservative investors surmise that bigger is safer. Market leadership. Companies should be leaders in their industries. Perceived staying power. You want companies with the financial clout and market position to weather uncertain market and economic conditions. It shouldn't matter what happens in the economy or who gets elected. As a conservative investor, you don't mind if the company's share prices jump. Who would? But you're more concerned with steady growth over the long term. Aggressive investors can plan long term or look only over the intermediate term. But in any case, they want stocks that resemble jackrabbits. They show the potential to break out of the pack. Aggressive stock investors want to invest their money in companies that have exhibited some of the following qualities. Great potential. The company must have superior goods, services, ideas, or ways of doing business compared to the competition. Capital gains possibility. You don't even consider dividends. If anything, you dislike dividends. You feel that the money that would have been dispensed in dividend form is better reinvested in the company. This, in turn, can spur greater growth. Innovation. Companies should have technologies, ideas, or innovative methods that make them stand apart from other companies. Aggressive investors usually seek out small capitalization stocks, known as small caps, because they have plenty of potential for growth. The simplest definition of risk for investors is the possibility that your investment will lose some or all of its value. Yet you don't have to fear risk if you understand and plan for it. You need to get familiar with the concept of risk. You must understand the oldest equation in the world of investing, risk versus return. This equation states the following. If you want a greater return on your money, you need to tolerate more risk. If you don't want to tolerate more risk, you must tolerate a lower rate of return. Financial risk is a real concern, even when the economy is doing well. Some diligent research, a little planning, and a dose of common sense help you reduce your financial risk. In the stock investing mania of the late 1990s, millions of investors, along with many well-known investment gurus, ignored some obvious financial risks of many then popular stocks. Internet and tech stocks littered the graveyard of stock market catastrophes during 2000 to 2001 because investors didn't see, or didn't want to see, the risks involved with companies that didn't offer a solid record of results, profits, sales, and so on. Remember that when you invest in companies that don't have a proven track record, you're not investing, you're speculating. Investors who did their homework regarding the financial conditions of companies such as the Internet stocks discovered that these companies had the hallmarks of financial risk: high debt, low or no earnings, and plenty of competition. They steered clear, avoiding tremendous financial loss. Investors who didn't do their homework were lured by the status of these companies. the poster children of booming internet fortunes, and lost their shirts. Of course, the individual investors who lost money by investing in these trendy, high-profile companies don't deserve all the responsibility for their tremendous financial losses. Some high-profile analysts and media sources also should have known better. The late 1990s may someday be a case study of how euphoria and the herd mentality, rather than good old-fashioned research and common sense, ruled the day, temporarily. The excitement of making potential fortunes gets the best of people sometimes, and they throw caution to the wind. Historians may look back at those days and say, what were they thinking? Achieving true wealth takes diligent work and careful analysis. Rising and falling interest rates offer a special risk to stock investors. Historically, rising interest rates have had an adverse effect on stock prices. Now I'll outline several reasons why. Rising interest rates have a negative impact on companies that carry a large current debt load or that need to take on more debt because when interest rates rise, the cost of borrowing money rises too. Ultimately, the company's profitability and ability to grow are reduced. When a company's profits or earnings drop, its stock becomes less desirable, and its stock price falls. A company's success comes when it sells its products or services. But what happens if increased interest rates negatively impact its customers, specifically other companies that buy from it? The financial health of its customers directly affects the company's ability to grow sales and earnings. For a good example of this situation, consider what happened to Cisco Systems in 2000. Because a huge part of its sales went to the telecommunications industry, Cisco's profitability depended on the health of that entire industry. The telecom industry's debt ballooned to $700 billion. This debt became the telecom industry's financial Achilles heel, which in turn became a pain in the neck to Cisco. Because telecom companies bought less, especially from Cisco, Cisco's profits shrank. From March 2000 to March 2001, Cisco's stock fell by nearly 70%. As of September 2001, Cisco's stock price continued to decline because the companies that were Cisco's customers were hurting financially. When interest rates rise, investors start to rethink their investment strategies, resulting in one of two outcomes. Investors may sell any shares in interest-sensitive stocks that they hold. Interest-sensitive industries include electric utilities, real estate, and the financial sector. Although increased interest rates can hurt these sectors, the reverse is also generally true. Falling interest rates boost the same industries. Keep in mind that interest rate changes affect some industries more than others. Investors who favor increased current income versus waiting for the investment to grow in value to sell for a gain later on are definitely attracted to investment vehicles that offer a higher rate of return. Higher interest rates can cause investors to switch from stocks to bonds or bank certificates of deposit. High or rising interest rates can have a negative impact on any investor's total financial picture. What happens when an investor struggles with burdensome debt, such as a second mortgage, credit card debt, or margin debt, debt from borrowing against stock in a brokerage account? He may sell some stock in order to pay off some of his high-interest debt. Selling stock to service debt is a common practice that, when taken collectively, can hurt stock prices. The U.S. economy now faces perhaps the greatest challenge since the Great Depression: debt. In terms of gross domestic product, GDP, the size of the economy is about $11.5 trillion, give or take $100 billion. But the debt level is about $37 trillion. This already enormous amount does not include $44 trillion of liabilities, such as Social Security and Medicare. Additionally, yikes, there's more? Some of our financial institutions hold over $50 trillion worth of derivatives. These can be very complicated and sophisticated investment vehicles that can backfire. Derivatives have, in fact, sunk some large organizations, such as Enron, and investors should be aware of them. Just check out the company's financial reports. Because of the effects of interest rates on stock portfolios, Both direct and indirect, successful investors regularly monitor interest rates in both the general economy and in their personal situations.